Good afternoon. Since the previous meeting of the Monetary Policy Committee, the inflation outlook has improved. This was mainly due to the further appreciation of the rand exchange rate following the benign market reaction to the US Fed monetary policy tightening, as well as the significant narrowing of the domestic current account deficit. The more positive growth outlook in the advanced economies has also contributed to a more favorable environment for emerging markets generally. However, the recent heightened domestic political uncertainty has reversed some of these exchange rate gains, and the risk of further rand weakening overshadows the inflation outlook. Domestic growth prospects remain constrained, although the low point of the cycle is probably behind us. Demand pressures are expected to remain weak amid low business and consumer confidence. The year-on-year inflation rate, as measured by the Consumer Price Index, for all urban areas moderated to 6.3% in February from 6.6% in January, in line with market consensus expectations. Food price inflation, which measured 10%, moderated for the second consecutive month following its recent peak of 12% in December. The contribution of the category of food and non-alcoholic beverages to the overall inflation outcome declined from 1.9 percentage points in January to 1.7 percentage points in February. The bank's measure of core inflation, which excludes food, fuel, and electricity, measured 5.2%, down from 5.5%. This follows a recent peak of 5.9% in December 2016. Producer price inflation for final manufactured goods measured 5.6% in February, compared with 5.9% in January. The category of food products, beverages, and tobacco products decelerated for the sixth consecutive month to 8.4%, following its recent peak of 13.4% in August last year. The inflation forecast for the bank has improved, reversing most of the deterioration seen at the previous meeting of the MPC. Headline inflation is now expected to return within the target range during the second quarter of 2017, compared with the fourth quarter previously, and to remain within the range for the forecast period. CPI inflation is expected to average 5.9% for the year, compared with 6.2% in the previous forecast, while the forecast for 2018 has moderated from an average of 5.5% to 5.4%. The forecast period has been extended to 2019, with an expected average of 5.5% for the year. The improvement is mainly due to a more appreciated exchange rate assumption. Despite the recent depreciation, the current level of the rand is still consistent with the exchange rate assumption in the forecast. Although the international oil price assumption remains unchanged, the exchange rate is expected to lead to lower petrol price inflation and is reflected in a downward revision to the assumption for administered prices. The favorable trend is partially offset by a slower pace of disinflation in food and non-alcoholic beverages, driven by an expected acceleration in poultry prices in particular. Food price inflation is now expected to average 7.4% and 5.2% in 2017 and 2018, compared with 7% and 5% previously. The forecast for core inflation is marginally lower than before, at an average of 5.4% in 2017 and unchanged at 5.2% in 2018. An average core inflation of 5.3% is expected in 2019. Inflation expectations are, as measured by the Bureau for Economic Research, show a deterioration over the near term in particular. The average expectation for 2017 has increased from 5.8% to 6.2%, with the largest upward revision coming from businesses and labor respondents. The average expectation for 2018 increased marginally from 5.8% to 5.9%, while the expected inflation for 2019 is 6%. By contrast, average inflation expectations over 5 years declined by 0.1 percentage points to 5.7%. Median inflation expectations of economic analysts, as reflected in the Reuters Econometer survey conducted in March, are more or less unchanged since January. Inflation is expected to average 5.8% in 2017 and 5.5% and 5.4% in the coming 2 years, roughly in line with the bank's forecast. Inflation expectations implicit in the break-even inflation rate, that is the yield differential between conventional bonds and inflation-linked bonds, had declined since the previous meeting, but have since spiked following the recent depreciation of the rand and remain above the 6% level for longer-dated maturities. The global economy shows continued signs of a broad-based improvement. The growth outlook in the US remains favorable, with business confidence indices at high levels. However, there is growing uncertainty about the timing and the size of the expected fiscal stimulus. Tax reform may take longer than anticipated following the recent failure to repeal the Affordable Health Care Act. Growth prospects in Japan and Europe are also more promising, with the PMI reaching a 6-year high in the euro area, led by services sectors in France and Germany. The extent to which the sustainability of this improvement is dependent on the highly accommodative monetary policy stance is still unclear. The outlook for emerging markets is also more positive, in part driven by the recovery in the advanced economies and stronger demand in China. Firmer commodity prices have also helped, but an oversupply of some commodities could limit these gains. Global inflation provides a mixed picture, with the recent decline in international oil prices threatening to reverse the broad-based increases in headline inflation in the advanced economies. Some inflation normalization is evident in the US and the euro area, but Japan is showing lost momentum in price and wage growth. Inflation in the United Kingdom is expected to overshoot the target for some time as the economy adjusts to a weaker currency. Similarly, inflation experiences in a number of emerging economies have reflected divergent currency movements. The US Fed raised its policy rate in March in response to the stronger inflation trend and improved growth outlook. While this action was widely expected, the gradual nature of the expected interest rate cycle implicit in the forward guidance surprised the markets. Policy rates are expected to remain at low levels for some time in most of the advanced economies until more favorable inflation and growth dynamics are more firmly entrenched. For the past few months, the rand exchange rate has been relatively resilient, along with a number of other emerging market currencies. While most measures of the emerging market risk have narrowed over recent months, those for South Africa have widened again over the past few days. The rand has depreciated significantly in response to increased domestic political uncertainty, and the exchange rate has re-emerged as an upside risk to the inflation outlook. Since the previous meeting of the MPC, the rand has appreciated by 3.9% against the US dollar, by 4% against the euro, and by 3.4% on a trade-weighted basis. The prospect of US monetary policy tightening has been seen as a risk to the exchange rate. However, the rand and other peer currencies strengthened in response to the Fed actions in March, indicative of revised market expectations of a more moderate tightening cycle than that priced in. The rand has also been underpinned by favorable terms of trade trends. Furthermore, the improving trend of the deficit on the current account of the balance of payments has reduced the perceived vulnerability of the rand to possible capital flow reversals. However, while significant adjustment of the current account has occurred, the deficit is not expected to remain at the level seen in the fourth quarter of last year. The domestic growth outlook remains weak following the negative growth recorded in the fourth quarter of 2016. The 2016 annual GDP growth of 0.3% is likely to have been the low point of the growth cycle, and a mild recovery is expected over the forecast period. The bank's forecast for GDP growth has been revised up by 0.1 percentage points in both 2017 and 2018 to 1.2% and 1.7%, with growth of 2% forecast for 2019. While growth is expected to be below estimated potential output of around 1.4% in the near term, the output gap is expected to narrow to some extent in the latter part of the forecast period. The more favorable growth outlook is consistent with the bank's leading indicator of economic activity, which has increased for 6 consecutive months. The main drivers of growth are expected to be net exports and positive, albeit weak household consumption expenditure growth. Some impetus is expected to come from fixed capital formation in the outer period of the forecast. At a sectoral level, the agricultural sector is expected to return to positive growth following good rains in a number of regions and improved maize crop estimates. A modest recovery in the manufacturing sector is expected following 2 consecutive months of the ABSA PMI being above the neutral 50-point level, whilst the mining sector is forecast to respond more favorably to favorable commodity prices. Low growth in gross fixed capital formation remains a downside risk to growth in the short term. In 2016, gross fixed capital formation contracted for the first time since 2010, with the ratio of fixed capital formation to GDP declining from 20.4% in 2015 to 19.6% in 2016. Private sector investment remains particularly weak, having contracted for 5 successive quarters. This is reflected in the RMB BER Business Confidence Index, which increased marginally in the first quarter of 2017, but at 40 index points remains well below the neutral level of 50. The BER Manufacturing Survey shows a sharp decline in expected capital investment over the next 12 months, with the political climate cited as the main reason. The constrained growth outlook does not bode well for the employment creation in the economy. According to the quarterly labor force survey, in the fourth quarter of 2016, compared to the fourth quarter of 2017, employment increased by 0.3%, whilst the number of unemployed grew by 11.3%. This resulted in an increase in the unemployment rate by 2 percentage points to 26.5%. Consumption expenditure by households, which grew by 0.8% in 2016, remains subdued amid low consumer confidence. While growth of 2.2% was recorded in both of the final two quarters of 2016, negative retail and wholesale trade sales growth in December and January underscore the likely persistence of this weakness. New vehicle sales continued to decline in February, although exports increased significantly. These trends are expected to persist as the impact of a higher tax burden, low employment growth, and weak wealth effects take their toll on consumption expenditure. In addition, credit extension by banks to the private sector continues to grow at low rates, particularly to the households amid a further decline in the household debt to disposable income ratio. Expenditure will be supported to some extent by positive but moderate real income growth. Fiscal policy, as outlined in the recent budget, remains committed to a steady pace of deficit reduction over the next 3 years. Lower tax revenues relative to budget, partly as a consequence of slower economic growth, have resulted in a shortfall to be filled by a combination of lower expenditure growth, increased fuel levies, and other excise duties, and a number of tax changes. These include limited compensation for fiscal drag and a higher marginal tax bracket for high-income earners. The tax increases are expected to act as a drag on household consumption expenditure, particularly for middle and upper-income earners. International oil prices have declined following increased oil inventories and weak compliance with the OPEC brokered deal to restrict output and an increase in shale gas production in the US. Although Brent crude oil prices increased by about 10% in the wake of this agreement, these gains have been largely reversed, with oil prices back in the region of $50 per barrel for the past 3 weeks. The impact on the domestic petrol price will be evident in April, when a reduction is expected. Despite the 39 cents increase in the road accident fund and fuel levies provided for in the February budget. Since the previous MPC meeting, the inflation outlook has improved. However, the risk to the inflation forecast has been affected by the reaction of the exchange rate to the current elevated levels of political uncertainty. At current levels of around 13 rands against the US dollar, the exchange rate is still moderately stronger than the level implied in the exchange rate assumption in the forecast. However, the rand is likely to react further to unfolding developments until a greater degree of certainty and confidence is restored. The possibility of significant overshooting of the exchange rate in the short run also cannot be ruled out. As always, the MPC will attempt to look through short-term fluctuations and focus on long-term trends in its policy settings. The MPC remains concerned about the elevated level of inflation expectations. While the near-term reversal was not unexpected, given the deterioration of the short-term inflation outlook in January, the longer-term expectations remain anchored uncomfortably at the upper end of the target range. Not all the inflation risk factors are on the upside. The deterioration in the forecast at the previous meeting was due in part to a higher international oil price assumption. This assumption has not been adjusted to reflect the recent market developments. There is a downside risk to this assumption, given the possibility of these more moderate trends persisting. A further downside risk comes from electricity price increases, which could turn out to be lower than the 8% currently in the forecast from mid-2017. The final price determination by the energy regulator is yet to be announced. Overall, the MPC assesses the risk to the inflation outlook to be moderately on the upside, mainly due to the high degree of exchange rate uncertainty. The MPC sees no evidence of significant demand pressures impacting on inflation. The growth outlook remains disappointing, and the MPC is concerned that increased political uncertainty could impact negatively on private sector investment and household consumption expenditure, and further undermine employment growth. The risks to the growth outlook are therefore assessed to be on the downside. In light of these developments, the MPC has decided to keep the repurchase rate unchanged at 7% per annum. 5 members preferred an unchanged stance and 1 member preferred a 25 basis point reduction. The MPC is of the view that we may have reached the end of the tightening cycle. However, the committee would like to see a more sustained improvement in the inflation outlook before reducing rates. This assessment may, however, change if the inflation outlook and the risks to the outlook deteriorate. At this stage, let me invite you to pose any questions that you might have, and please, as usual, identify yourself and the media house that you represent. The gentleman in a white shirt.
Governor, good afternoon. Arabile Kumete from Bloomberg News. My question is, how have the effects of this week's recent events affecting the currency vastly changed your estimates that you've then given to us? Have they changed in the last week?
Okay, Madam.
Good afternoon, Governor. You say in your speech...
You are not Arabile, are you?
No, I'm Amogelang Bata from Bloomberg News. You say in your speech that the assumptions that you have for the rand are more appreciated than the current levels. Did you factor in, and if so, to what extent have you factored in the impact of political risk or uncertainty on the rand? Because we're seeing quite a lot of volatility in the currency due to those developments.
Any other? Ma'am, welcome back.
Thank you, Governor. It's Mary Misa from FinWeek. Okay, you've talked about rand volatility posing an upside risk to inflation and political uncertainty being behind the recent bout of volatility we've seen. There's been a lot of speculation that interest rates might be cut in the second half of the year. How has this volatility and uncertainty affected the likely trajectory of interest rates? Has it affected it at all?
Just a follow-up question on her question. To what extent have the recent events and the impact thereof on the rand reduced the possibility of a rate cut later in the year? Is it completely ruled out?
Can we take the last one in this round? Tsepo?
Tsepo Moe, SABC News. Governor, you often say that you actually don't target the level of the rand, but you're more concerned about the upward movement in the currency. But if you look at the recent development, although there's been some level of volatility, but the currency has not substantially moved either way. Are you concerned about this? And when can we say that it's starting to pose a significant risk?
Hillary?
Yeah, Governor, one more on the inflation outlook. You say that you want to see a more sustained improvement, and one almost has the sense from the tone of the statement that had it not been for the round of recent political uncertainty and the risk which that poses to the rand, the committee would have been looking quite seriously at cutting rates in the near future. But my question is this. You've got CPI inflation averaging 5.9% for this year, 5.4 and then 5.5. Is that not still too near the top of the target range to justify a rate cut or a series of rate cuts? And when you talk about a sustainable improvement, I mean, would you like to see something better than that? Thanks.
Okay, there was a hand there and a hand there. Can I take this? Can we take this round and then we come back? We come back to you. Arabile, the effects of the political developments and what changes we had to make. One of the skills that is very short within central bank is political analysis. We employ economists, so we can't analyze which direction the politics are going. So, to the extent that there are political developments that have impacted on the currency, we will be concerned about the movement of the currency because we can't diagnose which direction the politics are going, which we just not designed to be focused on that. We spell out in the statement that we have kept our exchange rate assumption the same. So the fact that there had been movements neither here nor there, we decide on assumptions a good 3 weeks before ahead of the MPC. So the developments this week didn't affect our exchange rate assumptions. And even after the movement of the currency, we say that the current level of the exchange rate still does not have an impact on our inflation forecast because it is still, although you have had a depreciation, it is still below the assumption that we have in the forecast. And that list of assumptions is in front of you. And I guess that also deals with Amkhelang's question about the levels of the exchange rate. The assumption is very clear. Miriam, the volatility of the rand and the speculations about a rate cut later in the year, in a way, you know, the market seems to have run ahead of itself because you've got to look at what the inflation outlook is, what the growth outlook is, what are the risks attendant to each of those outlooks in order to form a view. And I got worried that the focus tended to be the rand has done this, therefore there is going to be a cut in the later part of the year, which I had found strange. You've got to look at all of these variables and how they interact with each other. And sometimes the impact could be in opposite directions, which is why in the statement we spell out that the risks to the inflation outlook are not all on the upside, that they
Whether you're looking for a restaurant, public transport, or a university, a lot of us use our smartphone apps to find the closest one. On Network, we chat with those who play a role in Africa's tech space.
We have taken financial services closer to the people. Yeah, mobile penetration is pretty high.
Apple take 30%, keep 70%.
On Network, we give you Africa's social media and technology news. That's Network with Ms. Phumelele Zondi every Sunday at 7:30 p.m. Central African Time.
Umphakathi wexwayiswa nga200 rand imbumbulu. Kepha labanye bathi akusuye 200 rand kuphela lo inkinga.
Into sine problem nayo abo 100 rand. Labo ke ababonakali awusheshi uyibone ukuthi fake.
Iphuma phi pho imali imbumbulu?
Ahlanganise lamaphepha akamnyama afake 100 rand yamphakathi from lapha eclean kwavela 100 rand ayi3.
Can I trust you, sister?
On man, I'm in the business of making money.
Ubese uthatha lo 100 rand lesimnike wona wawufaka emkhathini walamaphepha lamabili. Emva kwaloko uthethe stap lesimnyama wasigcobisa etikwalamaphepha. Emva kwekuyomisa le mali ubese usibuyisela lo 100 rand lesimnikete wona ekuqaleni. Uphinze wasibhanisela ngalomunye 100 rand.
Welcome back. A special broadcast now on the latest decision by the Reserve Bank on interest rates. The repo rate staying steady at 7%, which leaves the prime lending rated banks at 10.5%, announcing there by the Governor of the Reserve Bank, Lesetja Kganyago. Well, let's get some analysis now. A lot said about the rand, a lot said about inflation and growth. With me, Kevin Lings, Chief Economist at Stanlib. Thanks very much for coming in. And Mamelo Matlinga from the macroeconomic analyst at FNB. Thank you very much for talking to us. I want to start with you, Kevin. How do you describe this announcement or this address this afternoon? Was it dovish, was it hawkish, or a mix of both?
I think it was a little bit more dovish than we had at the last MPC meeting. Remember last meeting they were warning about the possibility still of an interest rate hike. They'd revised up the inflation forecast. They were still worried about a range of factors, including food inflation, petrol inflation. This time around, they seem a little bit more sanguine. I would say a little bit more concerned about, obviously, what the currency is doing, but in general, revising down their inflation forecast quite meaningfully. Obviously, their growth number is still fairly weak, although they did revise it a little bit. So clearly still concerned about growth, but a little bit more comfortable on the inflation outlook. And so they're edging closer to this idea that they could well cut interest rates later this year. I think that's still a possibility.
It's very interesting, though, Mamelo, that this 3 days of meetings and decision-making this week was done amid a climate of a rather tumultuous climate, such political uncertainty. We've seen here the Reserve Bank governor making reference to it. What do you think they were thinking while considering what to do with interest rates as the events around the finance minister unfolded? Because it had an effect on the key component of inflation, which is the rand.
Definitely. I think, a week ago when we were sitting and looking at the rand, we saw it sustainably below 13. And then come Monday, the rand depreciated quite significantly. Yep. And I think at the events of Monday not unfolded, I think the tone in the statement would have been significantly different. And it's very unfortunate that they're dealing with this very uncertain political climate, which could turn very quickly, as we're seeing right now. As I said, we're below 13, and we're trading around 13 with potential to go even weaker should the situation worsen. And I think once there's a little bit of clarity, if any, as the months progress, we will see a change in terms of how they approach the inflation numbers. I think, as Kevin rightly mentioned, that the statement does sound a tad dovish, but unfortunately they are quite restricted by this uncertain political climate.
See, sorry to interrupt, I don't think they want to get caught into an expectation of an interest rate cut and then find that the political turmoil intensifies and the rand weakens even further. And let's say that the rand is now 13.50, approaching 14 rand, and suddenly the inflation outlook changes very materially. And then they've been messaging that they're about to cut interest rates. So my sense is there's a cautious tone to some of their statements. Overall, they're a little bit more comfortable, but they don't want to get people too fixated on the idea that an interest rate cut is an automatic guarantee later this year.
And he does say, though, Melo, that it is the currency value and the forecast of that that's probably the biggest upside risk to inflation, doesn't he?
Definitely, and I think we've also had to adjust our numbers quite significantly following the depreciation in the rand. And I think, we'll just have to wait and see whether there is a change in the currency. And right now, it's very difficult to predict. I mean, there's a number of analysts that are coming out saying that they see the rand going to 15.50. And if we are operating in that environment, then clearly there's absolutely no chance of interest rate cuts anytime soon.
You were speaking about interest rate cuts earlier, Kevin. He does say, though, that we have reached the end of the hiking cycle, with a caution.
Yeah, I think the caution is if, as you say, if the rand does continue to weaken and suddenly inflation looks like it's going back above the target, or meaningfully above the target, then he may well respond by hiking rates as a way to try and defend the exchange rate and perhaps try get inflation back inside the target again. So you can't rule it out entirely. But as things stand at the moment, based on the best assumptions he's got, you would expect that this is the top of the rate cycle for the moment, and that the next move should be a cut in rates. But you've got to be cautious about when you time that. And it may well take a little bit longer than what was anticipated literally a week ago, 2 weeks ago.
Mamela, what do you make of the slightly improved projection on growth? From 1.1% for 2017, he's now got it at 1.2%.
Look, it's neither here or there. I mean, 1.2%, 1.1 really doesn't make much of a difference. I think he highlights that, confidence is still very weak because of the uncertain economic climate. And we definitely see it in the business confidence index. And if you look at that index relative to how private sector fixed investment performs, they almost trend together. So we certainly need to see an improvement in business confidence and a pickup in gross fixed capital formation. They still have it as negative for this year, and so do we. I wouldn't read too much into a percentage increase. In fact, at the end of the statement, he highlights that risks to the growth outlook are significantly to the downside, especially if the political climate does not improve. It's going to weigh on investment, and it's going to weigh on household consumption expenditure, and we share the same sentiment. I mean, I wouldn't read too much into a marginal improvement in the GDP numbers. I think they're still very weak.
And that's so important for jobs, isn't it, Kevin? I mean, he's put down the fact that people are just not investing. Businesses are not investing. If that doesn't happen, you won't get the jobs.
That's right. So business investment is in a deep recession. I would say it's actually at a point of being in a state of depression. Business has almost withdrawn from this economy in terms of wanting to expand or put more capital. They haven't left the country. They're still operating. They're still making good money. Their profits are good. Their cash on hand is good. But what they're not willing to do is expand capacity and employ. And obviously without employment, you just can't get sustainable pickup in growth. The one thing that I would want to just flag here is that, we have to acknowledge that there's a nice move coming through on the oil price, and that's pushing down the petrol price. And we've got the fuel levy increase coming through next month and the road accident fund of 39 cents. Yet the petrol price should come down next month 20 to 25 cents. And I think that one of the benefits that we see now in terms of the inflation outlook, and possibly a little bit in terms of growth, is the fact that the oil price has come down. And it may well languish at this level for a while longer, around $50 per barrel. And so that provides us with a little bit of relief in this environment. So it's not as if it's all bad news at this stage. There are one or two factors that are helping us. But obviously, the currency becomes now the overriding short-term indicator. And I would imagine that as we project forward to the next MPC meeting, we've got to factor in just how much political stability is likely to be, how much currency stability, as you try and forecast those interest rates. To get comfortable on your interest rate forecast, you're going to have to get comfortable on your political outlook, unfortunately.
Do you think we can start paying less attention to the effects of drought now on inflation?
Yes, definitely. I think if we look at your grain prices specifically and how that component has performed over the past 2 months, if you look at grains, you look at vegetables and so on, we saw that contract for the first time in year-on-year terms. This is vegetables. And if we look at grain prices, those are starting to increase quite significantly. But the caveat to all of this would be meat prices, and they flag it again in the statement, and they did in January. So if you look at the movement between grain and meat prices, is that your meat prices are starting to increase because the effects of the drought on meat prices ultimately resulted in farmers culling their herds and then pushing supply of meat into the market, which resulted in meat prices that declined somewhat.
Yep.
And they are in this period of rebuilding stock, meaning that meat prices are going to stay elevated for quite some time. So the drought effect when it comes to grains and vegetable prices and so on, I would say that's behind us. But meat prices still remain relatively sticky.
Yeah. How long do you think we will have that component or that risk there, Kevin?
In terms of
the meat prices?
Meat prices, probably for all of this, yeah. It takes a while to rebuild herds. It can take actually, 2 years to try and get the herd back up again. So I think we're going to have it as a risk. But I think overall, I'm comfortable with the idea that food inflation does moderate into single digits, probably around about the 6-7% during the course of this year. And I think that's enough for the Reserve Bank to feel comfortable with where food inflation is going. And then next year, I do expect another moderation, assuming a reasonable agricultural season.
All right, let's get a little bit more analysis after the break. And when we come back, we'll talk more about what the rand and inflation, as well as the growth prospects are for the country. Stay with us.
Water-wise, water is an essential need. The scarcity of it could lead to loss of many lives, including livestock, plants, and much more. It requires us to use it sparingly and responsibly in times of need, failing which our taps and sanitation will not function. For more on water and weather issues, stay tuned to News Today, every Friday at 4:45 Central African Time. SABC News, making you water-wise.
Thank you so much for tuning in to Media Monitor. I'm your host, Alicia Jali. What has been happening on the digital front?
To win the CAF Championship was a huge thing, and perhaps we ought to have celebrated him even more.
Absolutely.
73% of our schools, regardless whether they're in the township or they're in urban areas, if you go to those schools, you are guaranteed a matric pass.
It is the one thing that we haven't done well as a country. We have thrown money at it. I mean, if you ask for figures, you'll be told we're spending well in education.
90 billion.
But the performance of the system has not been good enough.
Right, welcome back. We're taking more analysis now of that latest announcements by the Reserve Bank Governor. The repo rate staying steady at 7%, which leaves the prime-rated banks at 10.5%. With me, Kevin Lings, Chief Economist at Stanlib, and still with me, Mamelo Matikinga, macroeconomic analyst at FNB. All right, so during the break, you were talking about this issue with core inflation versus real inflation and why it can be an anomaly at times. Just take us through that.
So in the last inflation print, we saw core inflation drop, I think, to a year low, 5.2%.
Yep.
So essentially what that means is that inflationary pressures are starting to, underlying pressures anyway, are moderating. And it's quite interesting that the core inflation forecast for 2017 doesn't change significantly. So it either suggests that they think that this was a blip and core inflation should pick up. But if I'm right in terms of my forecast and that core number continues to dip lower, it does mean that the inflation environment, our underlying pressures are improving, and headline inflation should also follow suit in a couple of months.
Does that strengthen the case that indeed somewhere this year we could see an interest rate cut?
It does very much. Core inflation is actually critical. It excludes all the volatile categories like food and energy. I would agree with that forecast. I think core inflation remains well inside the target. Doesn't mean it goes below the midpoint of the target, but I think it's comfortable, and I think it does feed into an argument that there's not a build-up of underlying inflationary pressure in South Africa. We don't really have a wage stimulus problem going on. I don't think we've got the same cost pressures in terms of electricity, etc. So as long as core inflation stays at around the 5% level, which is entirely possible, the argument will build for an interest rate cut. As long as you get away from the volatility to the headline number.
Yeah, volatility again. I mean, I think he spoke more about political instability in this MPC statement than he did in the past few. How significant is that? Because, I mean, we saw the Reserve Bank governor going out of his way to say, we don't have political advisors at the Reserve Bank. We deal with economists. Fact of the matter is, it has a direct bearing on the rand, doesn't it?
Definitely. The environment has changed significantly, and you must remember that the sovereign ratings are also monitoring the country quite carefully. Moody's is coming out on the 7th with their assessment. This is not to say that they're going to downgrade the country immediately, but all of these things obviously are going to influence at how they look at the economy. So the macros are improving. Our GDP growth, but GDP is expected to pick up, and inflation is indeed moderating. So on that front, we're doing quite well. But on the politics, it's still very uncertain, and they will monitor that. And if we do get downgraded, granted that has been priced in, but if it is a little bit more aggressive, God forbid, this is going to have a huge negative impact on the rand and consequently inflation and so on.
It also tells you that if it weren't for these political events, we'd be having a completely different conversation today.
It was a question put to him, wasn't it?
I think that's right, because I think the conversation would have been, you know, when do we see the cut, not if we see the cut. And we would have been debating, does it happen at the next meeting or does it happen later in the year? That sort of thing would have been a key. He would have been much more bullish on where inflation's going. He would have highlighted that the growth rates look slightly better. I think the whole tone would have been different. The politics has overridden that, and it's difficult for him to make a bold decision while you've got that level of political uncertainty.
How significant, Mamelo, is his point that we may have seen that bottoming on the minus 0.3% growth rate in the fourth quarter of last year? I would think it's a given, especially when you look at the other positive indicators.
We definitely share the same sentiment. So we are expecting to see a cyclical rebound this year, supported by the agricultural sector and also mining on the back of this improvement that we're seeing in commodity prices. But again, this brings me back to a point that I said, noted earlier, 1.2, 1.1 or 1.3%, which is what the Treasury has for GDP growth, is still very weak. He himself highlights that GDP is well below potential, and I think at some point, you know, we need to really start having serious conversations about structural reform and how we grow the economy sustainably. He also highlights in the statement that, you know, we had this huge shortfall in revenue, and this of course is on the back of GDP numbers that were slightly lower than anticipated, which impacted revenue and other factors. And if we are wrong on this 1.1% and we see a GDP number that's lower, it means that the fiscus is going to come under more pressure as the months progress going into this year. So we are seeing a turn, definitely, but the long-term growth, well, the growth forecasts that they have up until 2019 are still quite poor relative to where we've been historically.
Kevin, it almost seems as though if we don't get some sort of an injection, you're unlikely to see any turn of events on growth, rather than this very subdued line that we're witnessing now.
It's hard to imagine it. Obviously, the global backdrop, I would say, generally is supportive. Commodity prices right now are helping. The US growth doing slightly better. Europe actually doing slightly better. China doing quite well. All of that, I would say, is supportive. So from that perspective, we should see some uplift this year. But in terms of a real uplift, when we're talking about 3% growth, 4% growth, we're not going to get that without a pickup in confidence. And I don't think we're going to get a pickup in confidence without political stability. And it doesn't look like we're about to get political stability, which then translates into we continue on at these sorts of lackluster growth rates through all of this year until, I guess, we get to the ANC elective conference at the end of the year, and we get a better sense of where the leadership's going and what the leadership wants. And perhaps then there's a refocusing on how do we lift growth heading into the 2019 election. From a political perspective, that would make sense. Try and get the economy more robust before you go into the 2019 election. But between now and the end of the year, it's clear that there are a lot of political battles that are going to be fought. I don't think this is the only one around the Minister of Finance. I think there are many others in the background that will unfold. And so I think the political uncertainty will play out. What you hope is that we don't do so much damage to the structure of this economy while we're doing these political fights to, for instance, result in a credit rating downgrade, or to destroy confidence significantly, or to encourage more and more capital flight from this country. Those are the things we can't really afford. One understands that all emerging markets have these political wranglings. We're not unique in that sense. Brazil, Russia, Argentina, all of these countries go through similar events. Foreign investors know that, they appreciate that. They're not going to run away at the first sign of political trouble. It's a question of how much damage do you do to the structure of your economy while you're undertaking this political fight. And we worry at this point that you're going to start to do too much damage that is longer lasting, that impacts this economy over many years. So I think we've got to resolve this as quickly as possible and try get that confidence going.
And that's something we have control of. Something we have less control of is across the Atlantic, and the Reserve Bank governor alluding to it as well, or talking about it. That's the hikes in the United States, much more moderately than people had thought. Just give us your take on how much significance we should put on that.
What's quite interesting is that the Fed delivered their rate decision a couple of weeks ago, and we saw that the market had anticipated that the hiking cycle in the US is going to be gradual. And the dovish tone in that statement ultimately saw emerging market currencies actually performing quite better, because we're still providing higher real yield. So the market has priced in a gradual interest rate hike in the US in a situation where that turns to being more aggressive, which at this particular point doesn't seem very likely, because we're seeing this drop in real wages. But let's say in a situation where it does become aggressive, that's going to be rand negative. But as things stand, we offer quite attractive real rates, and that has supported the rand. It's just very unfortunate that the current political landscape has obviously overshadowed that.
And that's true, Kevin, isn't it? Our yield is an attractive yield, isn't it?
It's very attractive, a yield of over 8% on South African government bonds. If you look at the US government bond, you get a yield of just over 2%. So the difference is quite significant, and many foreign investors in Europe and the US look at South Africa and say, I'd rather get a return of 8% or 9%, as long as the currency is reasonably predictable and stable. So a lot of money was coming into South Africa on the back of that over the last couple of years, and rightfully so. But obviously this round of uncertainty makes those foreign investors question it, say, are we going to certainly see the same sort of yield, because we worry about the Minister of Finance and whether the Treasury will be managed appropriately. And then we worry about what this means for the currency. So right now, foreign investors will be reassessing their portfolios. It doesn't mean they run away, but that reassessment can leave us a little bit more vulnerable.
All right, we're going to have to leave it there. Kevin Ling is Chief Economist at Stanlib, Mamelo Matikinga, macroeconomist or macroeconomic analyst at FNB. Thanks to both of you for coming in and sharing your views.
Pleasure.
And that's where we'll leave it. That's the special broadcasts from the Reserve Bank's Monetary Policy Committee. The repo rate staying steady at 7%. Your prime rate also staying steady at 10.5%. That's where we leave it. Bye for now.